Like Marriott better, though.
I do like, well, because of valuation. Marriott's 25 times.
Okay.
But I think Airbnb, listen, Airbnb is also taking market share. That's clear. That's obvious. So I've reversed my sentiment towards this stock because for the majority of 2022, I was very skeptical about their ability to improve the fundamental environment and to carry that into or translate into an appreciation for the stock price. It's doing it now.
All right. We will watch that for the remainder of overtime as well. But let's turn our attention to the market at large because you got, we're waiting for the CPI, a little hotter than expected. Stocks pretty much took it in stride, I think you could say, given the way we held up throughout the day and the way we finished.
Did not break the fever for the NASDAQ-listed technology, communication services, consumer discretionary stocks that have been rallying so far in 2023.
Are you surprised by that? Because rates moved up.
Rates moved up.
But yet those stocks didn't go down.
Rates moved up, but the VIX volatility declined significantly, down 7% on the day, below 19 now. Dollar moved a little bit lower. So the overall momentum right now in the interim, I said this with you yesterday on the halftime report, in the interim, the bullish forces are in control. The runway is clear for them in the immediate term to extend the rally further for Q1. Am I surprised what we got today? I think collectively all of us are looking for a moment where there's going to be this overwhelming fundamental evidence that's going to break this fever, because myself and others are very suspicious that a lot of these NASDAQ hyper-growth stocks and even some of the NASDAQ growth stocks can sustain the appreciation we've seen so far year to date.
So Airbnb is still popping up now, better than 9%, just to keep letting you know what's going on with that. Earnings report and the guidance obviously being viewed positively on the street. BTIG's Jonathan Krinsky today says we would fight the urge to chase tech strength here, given the widening divergence that you've seen, which you're alluding to and not positioned for. But I mean, if rates moving up doesn't break the fever, in the words that you used, what is going to reverse this trade?
Earnings. I think ultimately it comes down to earnings, because
we just had earnings, so we have to wait another whole earnings period.
I think I've said that. Yeah, I think the runway is clear into the April earnings report. Revenue growth, okay, up 5.8% so far. Earnings growth down. You've got a contraction of 3%, in particular in technology, the very sector that we're talking about. So while Jonathan is saying don't fight the urge, I can tell Jonathan, and actually putting real money to work in the market, there's going to be an underperformance, and that's what I'm doing right now because I have not accepted ownership of these types of stocks within my strategy.
Do you think the market is believing the idea of higher for longer? The rates market and Fed funds futures certainly have moved more in alignment with the Fed, but the stock market hasn't necessarily done the same. Is it in denial about a higher for longer idea? Post-jobs report, CPI today shows you how sticky this is going to be. It's not going to be a linear move lower for inflation by any means.
I think what the market is comfortable with, and yes, I think the market is now in alignment with the Federal Reserve, and that's clear when you look at pricing looking forward. But I think what the market is comfortable with is that the Federal Reserve is not adversarial anymore, because the speed at which monetary policy is being administered is not as intense or as rapid as it was in 2022. So now it's more about duration. It's more about 25 basis points coming in March, maybe another 25 basis points coming in May based on the economic data that we're getting currently, and maybe another 25 basis points. So it might be 25 basis points slowly dripping out. Now, let me just finish the thought on that. What does that lead to? To me, that leads to what has been my thesis all along for 2023. I think the second half of the year, in particular Q3, is where you see the lag effect really impact consumers and corporate earnings.
Some are not giving up on the idea of rate cuts this year, even though the market doesn't have that priced in. Listen to what Jeremy Siegel said on the halftime report today. I mean, the odds may have come down, but he's not fully given up. Listen.
I'd say the January data that we saw on payrolls made me think less likely. I still think it is likely, more than 50%, that they will cut. But maybe I thought it was 80. Maybe now I think it's 50% that they're going to cut.
What do you think of that? 50% chance of a cut.
But that means you have a hard landing in risk assets, you have a hard landing on Main Street, you have a hard landing in the economy.
Or you just mean that inflation,
or
you just mean that inflation's come down enough 2%? that maybe it doesn't have to get to 2% for a rate cut, but it comes down far enough that they actually cut.
I don't think if the inflation rate is 4% that the Federal Reserve is cutting, unless there's some form of geopolitical or exogenous shock upon the market.